for the Larry Kudlow Show. Entertaining and informative on the Red Apple Podcast Network.
Welcome back, folks. I'm Larry Kudlow. This is the Larry Kudlow Show. Hour 3, terrific stuff. You can live stream us on the Internet. How about those apples? Live stream us on the Internet, LarryKudlowShow.com, LarryKudlowShow.com. You can hear us all across the country, around the world, throughout the solar system, including the Milky Way. And please visit us, Fabulous Fox Business. Fabulous Fox Business, Monday through Friday, 4 to 5 p.m. Name of the show is Kudlow. And if for some reason you can't get there at 4, why, just text your favorite 9-year-old, and she will show you how to DVR the show. You'll never miss a thing. In fact, I'm interviewing President Trump, which I'm going down to the White House to play on Tuesday. So that'll be very interesting. I'm looking forward to it. Anyway, I'm looking forward to Dow 50,000. Here we are. And what a glorious thing, Dow 50,000. Everything went up yesterday, 2.5%, pretty much across the board. And I know the NASDAQ is maybe still recovering from its techie sell-off. And maybe will continue. I mean, you got the market widening. It's not just tech. Consumer staples for the week up 6%. Industrials up 4.7%. Materials up 3.5%. So it's not just tech. Anyway, we got two smart people to talk about this story. Nancy Tengler is the CEO and Chief Investment Officer of Lather Tengler Investments. She's got a book out there, The Women's Guide to Successful Investing. And Jon Najarian, co-founder of Market Rebellion. So let's just start by getting a little bit of an overview. Nancy Tengler, start with you. Dow 50,000, and the rest of it, what do you make of it?
Well, somebody famous and very humble once said, earnings are the mother's milk of stock prices. Or maybe not so humble. And we are seeing earnings growth mid double digits, so 13 to 15% are the projections. I mean, we've seen a tremendous number in the companies we own of what we call the triple play, beat, and raise, and yet the stocks were punished. And so I think that's one of those opportunities. This feels very deep-seeky to me. We were in buying a number of those names, during the period from DeepSeek to Liberation Day. And if you just looked at names like Advanced Micro, it was down 10.5% then, and then it ended up from Liberation Day up 108%. Or Broadcom down 15, up 102. Coherent down 17, up 173. So these are times when you want to take advantage, if you believe in the narrative, which we do, that productivity-driven growth is going to continue, and we're just getting started because these are transformative technologies that I think will change the way we live into the next decade. So we've been very focused on space, robotics, not just AI, nuclear and quantum, in addition. And that, I think, is what will drive excess total return going forward. So I'm not always optimistic. I was pretty pessimistic going into 2020, not because I knew about COVID, but we couldn't find any attractive names to buy. We're pretty optimistic because we're finding all sorts of companies. We've been broadening out the portfolio for a number of months into industrials and consumer discretionary as well as materials. And so we like those ISM numbers. I'd love to know what John thinks. They looked pretty exciting to me. We started to see improvements in the previous 2 months and in production, and then it bubbled up to the total manufacturing number moving expansionary last month. So I don't think there's a lot to hate. There's always a wall of worry, but we think the underlying fundamentals are really powerful.
I keep saying it, Nancy and John. I said it on the air yesterday. We went long in our first segment. Profits are the mother's milk of stocks. They're also the lifeblood of the economy, for that matter. But you've got a very small calculation. Wages minus productivity equals unit labor costs. Unit labor costs, because of the product, wages are going up, but the workforce is earning it because they're very productive. Productivity is rising rapidly, and unit labor costs, which is the ultimate cost, okay? And in some sense, it's the inflation rate for the whole economy, but it's the ultimate cost for companies. It's 1.1% last 4 quarters. That's all it is. But I keep saying this profit story. So look in the Wall Street Journal this morning. The Wall Street Journal, the great newspaper, business newspaper, etc. They have a bunch of articles about the Dow 50,000. Articles are uniformly pessimistic and never mention profits or earnings. Okay, I call them profits, but they don't go through it. I'm look at start on the front page and then turn to the break, and then it's unbelievable to me. No one talks about profits, John. John, I mean that.
I was just going to say, wasn't it Besson who called them a bunch of grumpy old men at the Wall Street Journal?
Well, they unfortunately.
Sorry, John.
But I mean, you know,
that's right.
I mean, you just cannot look at the stock market without looking at profits, or as they're called, earnings. All right, by the way. And let me give John one credit, though, very important credit. Ed Yardeni, okay. And I had him on the air. I mean, he's not some Trump Republican either, but he's just a good economist who understands economic growth. But he writes about profits all the time. I had him on the TV show. We talked about profits. He's the only one. Ed Hyman does profits too, but no one does them like Yardeni. And that's the key point. And Nancy's right. You're in middle. If you look at future earnings estimates from the street, you're in mid-teens. Okay, so that's pretty damn good, Jon Najarian.
Oh yeah, it is, and I agree with Nancy. That ISM this past week for January, 52.6, folks. They were looking for basically 48.5. It was 47 and 0.8 or 0.9 in December. So this was a blowaway number. This was great. And that's the manufacturing sector. That's people that are working in America. So as Larry said, profits of mother's milk of capitalism and so forth. Certainly seeing manufacturing, Larry, coming back the way it has is amazing. I mean, these are some of the strongest numbers we've seen since 22. And, of course, that was coming out of a shutdown. So I think Nancy's exactly right. That was a very positive sign this week.
John,
go ahead, sorry.
And I just want to add one thing.
Mm-hmm.
The ISM surveys, it's not what they used to be. A lot of the stuff, it was a great number, important number too. But a lot of their stuff is overseas. And it's included. They don't make a division between what's going on in America and what's going on overseas. The S&P 5, what is it? The S&P Global, blah, 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 whatever that thing is called. They also have their own version of the ISM, and they've been showing much stronger manufacturing for months. I just want to insert that because the ISMs are not. And the other thing is consumer confidence helped. The number helped up 3 months in a row and the highest in 6 months. Now, that Michigan survey, it's a lousy survey, but everybody looks at it. It's Democrats rule that survey, okay? It's like a poll. It's like a bad poll. But even the Democrats in that survey are coming around to more positive. Please continue, but I wanted to insert that.
Sure. Well, and your insight is always welcome and appreciated.
Don't listen.
I can't believe I'm on with the guy that's going to be talking with the president in a few days, and as well as Nancy. It's an honor to be on with both of you. But I think what we've seen is the moves in, for instance, the fear index. It shot all the way up to 22, almost 23 this past week. It came down fast yesterday. That 2% rally that Nancy and Larry were talking about, folks, that took the fear gauge back under 18 again. And that's definitely what we would like to see. That's the reaction you want to see if you were saying, boy, that certainly seemed like we had a flush in the market on Thursday. And clearly we did. Is it over? Could we see more downside from time to time? Yes, but not if we're seeing the kind of earnings that Larry's talking about, not if we don't see liquidations in gold and silver and Bitcoin to the same extent that we did see them. Some of that tied perhaps, or at least your favorite, the Wall Street Journal cited, I think, Kevin Warsh as one of the catalysts for that, Larry, when the president made that nomination. But I think this is going to be a great time to be in stocks. I think that shaking out some of the folks in AI in particular and some of the software stocks outside of that was something that was needed. You know, Michael Burry had been calling for that since October, and then we finally got it in the last little bit. And that takes us back down to a value level rather than an overbought fear of missing out level.
What is it? Axios. Oh my God! Why am I reading Axios? I don't know. It gets into my mailbox. Axios is, of course, they're pessimistic. It's a lefty website, but they've got this thing here: robots eat software, and they're saying that's why Microsoft has lost $280 billion net worth, Oracle $61 billion, Palantir $36 billion, AppLovin, Salesforce, Intuit. What does that mean? Robots eat software. That means the AI stocks are eating up the software stocks? I don't understand that.
Yeah, I think to a certain extent, yes. I mean, there's an awful lot of people that are sort of at my level of programming, which is absolute novice. But you can go over to Claude or any number of other websites, and all of a sudden it's programming for you. So do you need a whole bunch of software engineers that you're paying $200,000 and so forth for? No. I mean, do you need some? Yes. Do you need the numbers that they've had to have in the past at Meta and even at Amazon and Microsoft and Apple? No, you don't. It's just going to be one of those situations where, you know, it's Elon's world and we just live in it when they start rolling out. I mean, you know, when you shut down the Model X and the Model S and you turn those production lines into Optimus, the, of course, unbelievable robots that he is building, when you do that, you're talking about millions of those robots rolling out. And they are going to do some but again, the profitability of these companies is going to go through the roof. And I don't mean Tesla. That's going to do just fine. But I mean anybody who's able to reduce headcount and thus some of that spend for employees, not just CapEx, is going to just be, it's manna from heaven, Larry.
All right, I got to take a break. I want Elon to come back and do Doge 2.0. We got a lot of waste, fraud, and abuse in the government that he didn't get to. He only got to a small percentage of it. Talking stocks, Nancy Tengler, CEO and CIO of Laffer Tengler Investments, Jon Najarian, co-founder of Market Rebellion. We had so much fun in the first segment. We only have 4 minutes in the second segment. But I want to ask, so Nancy, start with you. I mean, so if robots are eating software, does that mean you don't buy Microsoft? You don't buy Oracle? I mean, really? Is that what's going to happen here?
Well, that's why I think this is kind of like DeepSeek, Larry, where everyone said, you know, the Chinese are building inferencing models for $6 million and we're spending billions. And it turned out that was a lie. But you got the sell-off. I think there will be companies that will be compromised. We exited Adobe and Salesforce a while ago on concerns, but we added to Microsoft on Thursday. We think there are survivors. I think you have to be picky. But what's interesting to me, too, is that, you know, we're getting all this feedback on CapEx spending, which used to be good when I was a kid. Companies were investing in CapEx. Yeah. But, you know, that same Wall Street Journal that was so pessimistic on the front page had an article on the second page this morning about Amazon, and it was kind of an accusation like they're paying less income tax. Their income taxes went down 50%, greater than 50%, thanks to the One Big Beautiful Bill Act. That's why these companies are spending. It will be stimulative for the economy, and the losers will shake out. But I don't think software companies like Microsoft and some of the other biggies are going away.
That was an incredible – that's another article that I want to rail against because you're right. First of all, they're spending a fortune, on capital. It's called capital deepening, right? Machinery, equipment, technology, R&D, and so forth. They're using the 100% immediate expensing in the one big beautiful bill, which is fantastic, which means not only will they have the greatest technology available, but they will also have plenty of money to give raises to their workforce, their wage earners, and they'll give them the best equipment possible. And it's fabulous. And that article was attacking them because it was like a left-wing article. Oh, you didn't pay enough in taxes. I mean, this is the Wall Street Journal. All right, honest to God,
the old man.
It just boggles my mind. Okay.
Yeah. Me too.
Well, so Jon Najarian, give me, what do you like here? Give me something interesting.
Well, just as you guys were both discussing, I mean, public software multiples are at multi-decade lows right now, guys.
Oh.
I mean, median revenue is like 3.6. That's the lowest in 10 years. If you look at stocks like ServiceNow, symbol NOW, I own that. Shopify, I just bought that, SHOP. Twilio, I'm looking to get into that, TWLO. A lot of these, I think, have significant upsides after some of these compressions that we've seen. Oracle, too. I mean, what Oracle said last August still applies. I mean, they have a huge AI backlog that's going to be paying dividends for shareholders for years, Larry.
I love this. Yeah. Look, the two ones at Axios, Oracle and Microsoft, because it's Axios, it tells me go out and buy them. Just go out and buy them. If the left doesn't like them, buy them. If the Wall Street Journal doesn't like profits, sell them. And it's crazy. The world is turning upside down. You guys are wonderful. Nancy Tengler, thank you. Jon Najarian, thank you.
The Larry Kudlow Show on the Red Apple Podcast Network.